Hi, good afternoon, everybody. Welcome to the call. So obviously, we'll start with the markets and then, talk a little bit in terms of our views in terms of sector overweights, underweights, etc. Uh, but certainly, I think we are in unprecedented times. Once again, COVID was one such event, but we are seeing this one also as an event which is turning out to be a little unprecedented. But certainly, I think from a market standpoint, the volatility has spiked up quite considerably, and as a result of that, things are fairly, it's become fairly challenging in that sense. But yeah, I mean, certainly, uh, from a standpoint in terms of the overall markets and all of that, I think each of these events, at least in my experience, have created a lot of good opportunities, for the equity markets as a whole. So let me just kind of begin and talk about the macroeconomic outlook, and then we'll wean that into the market structure at this point in time. So, irrespective of what is going on with the war and the global geopolitical dynamics, I think that both private and public sector capex is likely to continue over the next 2 3 years. And there are multiple tailwinds today for India, and this tailwind is actually getting even better. Especially with the China plus one. Now, a lot of countries are looking at India from a supply chain perspective. While this might be more of a long-term tailwind, because it's not going to happen in a hurry, obviously, but certainly over the next 12 to 18 months, you'll see a major push towards infrastructure creation, capex, both government as well as private sector. Um, the second area that normally we look at is the inflation, and at this point in time, things seems to be a little bit under control. I'll talk about some of the factors there. With the RBI on one hand beginning the rate hike cycle, simultaneously the government is doing its bit in terms of duty cuts, etc. And third, and most importantly, the global commodity prices cooling down. And I will tell you why this is so important. As we move ahead. However, the key risk in terms of the markets continue to remain. There is perhaps a fair bit of slowdown, high inflation, high interest rates in the Western world, which they've never seen in the last 50 years. And, of course, the Russian geopolitical situation continues to remain quite fluid. Of course, there are talks about, some sort of a compromise formula, but each time there is something like this, it doesn't really conclude one way or another. And once all these risks ease, which eventually it will, growth would once again be a priority, and will come back in terms of focus. But broadly, what I would like to leave you with is that India will still be the fastest growing GDP economies, across the world, and I think it's going to be very hard to ignore that. Um, some of the macroeconomic indicators also, are showing that there is appreciable recovery. If you look at power consumption, GST collections, e-way bill, railway freight, exports, etc. Except maybe two-wheeler sales and some bit of auto sales. Rest of the high frequency indicators are showing very good pickup. And and even if you look at it sector wise, for example, if I were to compare this with the pre-COVID levels, most of the sectors today are at higher, basically at higher than pre-COVID levels. If you look at construction, manufacturing, real estate, financial services, other services, utility, mining, even travel and hotels, they are also, they have also come up quite a bit, and they are slightly above pre-COVID levels. So, net, I think what we believe is that despite all what is going on in the world, I think India is stabilizing and then, trying to recover. In fact, before this war itself, the last 2 or 3 months, we had seen a meaningful pickup in economic activity. And based on that, we believe that, FY23 GDP will be more like 7%, which is, like I said, the highest that could be across the globe. Similarly, in terms of the RBI hikes, I think RBI has been trying to be ahead of the curve in terms of the rate hikes. But in comparison, I think compared to the West, I think India will have much lower hikes, primarily because, our inflation is still not completely out of control. Overall, I think even in terms of food inflation, India produces almost 90% of its requirement. So I think from a CPI inflation rate, also, I think things are pretty much under control because all these are domestically produced goods. I think, from all macroeconomic indicators, including foreign exchange, you're looking at roughly $600 billion of forex reserves, which means that the rupee is fairly resilient, really unlikely to depreciate significantly from here, unless, something really goes completely negative. So compared to many countries, especially in the emerging markets, I think India has done exceedingly well. Also, if you look at, once again, the private and public sector capex, the public sector is largely the infrastructure side, road construction, etc., where there is a lot of buzz. Similarly, in terms of the private sector capex, it holds a lot of promise in terms of, many sectors where you will see significant amount of growth in terms of the capacity expansion, primarily engineering, electronics, many such sectors. So I think net, the capex cycle growth will continue. And thanks to the PLI scheme, roughly 260,000 crores of outlay, capacity construction has already started in many of the sectors. There are 14 sectors, but broadly, the top 3 or whatever, is gaining a lot of traction in that sense. So from a macro standpoint, yes, there are challenges globally. India cannot remain too isolated, and that is the reason. And one of the main things I spoke about was the commodity side of it. We are already seeing commodity prices ease off quite a bit. If you look at the reduction in prices, it's been across the board. From the peak, you're seeing a very meaningful decline in steel, aluminum, etc. In fact, some of them are actually below 52-week lows. So, except maybe for coal and energy, which is really oil, rest of the commodities are pretty much on a decline. And that's very positive news for India. I mean, now the other joker in the pack is obviously oil, and because India imports almost 80% of its oil requirements. So it will have, some sort of an impact on the economy. But certainly, I think we are trying to figure out ways, through bilateral agreements with Russia, etc., to get oil at a much cheaper price. So So I think, except for oil and maybe coal to some extent, rest of the commodities are falling. So, that's pretty good news. So from a market standpoint, again, India is holding up exceedingly well compared to most emerging markets and most developed markets also. The volatility here is definitely much lesser. And so the real question comes, why are FIs selling, right? I mean, there's a massive, FI selling since the last maybe 7 or 8 months now. And the good part is that, domestic investors have been on the other side buying, which is again, something which is very, very new. At least I haven't seen it in my career. And that one of the reasons why the FI selling is happening is because global rates are rising. And when global rates rise, a lot of money generally tends to flow out of emerging markets and move to areas or asset class where returns are better. So because interest rates are getting higher, a lot of that money is moving away from equity into bonds. Similarly, a lot of the carry trade that used to happen with cheap capital from outside and buying domestic equity, that is also getting unwound because the cost of borrowing is going up. So, overall, I think and of course, the valuations in India were not exactly cheap, and with rising interest rates, typically equity valuations generally tend to go down. So as a thumb rule, a 1% increase in interest rate should effectively translate to about 15 in terms of market P's. So, and in my view, that 1% interest rate is probably in the price already. And which makes me believe that we are probably closer to the lows, and especially when you look at certain stock prices. Difficult to call the market direction at this stage because there's too many moving parts, especially on the geopolitics side. But certainly in terms of companies, and that's exactly what we're doing. From a portfolio standpoint, we're looking at specific companies, specific businesses where there is opportunity because of this FI selling. So the FI selling is primarily happening in a few pockets, right? And these are some of the sectors where they have a very large percentage. For example, financial services, IT, consumer discretionary. These are some of the areas where the FI holdings in some of these stocks are very, very high. And these are very high quality stocks also, by the way. So, and because they are able to sell, given the size and all of that, these sectors are facing the brunt from the FI selling. Now there could be a question as to when this selling could stop. I think, once inflation stabilizes, that's when, and the only reason for inflation to stabilize is perhaps the war coming to some sort of a conclusion, sooner than later. And if that happens, then I think there will be some retraction in terms of interest rates, etc. And hence, once that situation comes under control, you will see, growth as a theme coming back, because ultimately India is a growth market and, the fastest growing economy. You can't really ignore it for too long. So, even in terms of the corporate review and outlook, I think the fourth quarter numbers were very, very impressive, almost 24% growth in profits. But, it was led by largely banks and energy, but there were certain sectors which are already seeing significant raw material inflation, and hence there is a pushback in terms of demand, particularly the auto sector, similarly construction, etc. Where you're seeing gross margin pressures across. So, but fortunately, like I said, most of the commodities have started correcting, and hopefully by the second quarter, you will see that pressure easing. So for the next 1 or 2 quarters, I still believe that corporate India will have challenging times because of high raw material prices and inability of companies to raise prices or increase prices beyond a point without affecting demand. So once the commodity prices actually start declining even further, it'll slowly percolate into the system, and that probably will work with a lag of maybe 3 or 4 months. But stock markets will probably take cognizance of this and start repricing the equities, which is why I mentioned, with this rise in commodity prices and interest rates, etc., a lot of the stocks which were favorites are down 30, 40, even 50%. So this gives us a very, very good opportunity to kind of look at the markets and make adjustments wherever necessary, right, in terms of our portfolios. With that, let me just kind of move over to kind of the portfolio positioning. As you all know, ours is a more bottom-up, growth-oriented, high-quality kind of thought process in terms of portfolio construct. And like I said, high interest rates will have an impact on growth stocks, and that's exactly what is happening. So as a result of that, we are seeing a fair bit of underperformance. While we did exceedingly well till end of February, just when the war had started, we were doing exceedingly well because we had a growth-oriented portfolio, and growth was getting rewarded handsomely. However, since the war broke out, I think there is a lot of risk aversion, FI selling, putting a lot of pressure, valuation adjustment because of higher interest rates, and all of that. And because of that, I think the pressure is high on some of these growth stocks that we own. And as a result of that, the portfolio has been underperforming for the last few weeks. My sense is that given the way the volatile situation is there globally, perhaps we may still see some bit of challenges over the next 1 or 2 quarters. But I can tell you with great degree of confidence that these are the sectors which will make up for the growth over the next 3 to 5 years. So if you're looking at a 3 to 5 year horizon, then and if you look at the portfolios, like where are we overweights on, right? I mean, let's discuss one by one. Banking and financial services, is one area where we have been very, very bullish. The last 2 years have not been rewarding for the BFSI space, primarily because they were going through a lot of restructuring. But today, you evaluate them on any parameter, whether it is credit cost, lending growth, even the ROEs and ROAs of the banks, extremely healthy. And also they've already raised a lot of capital, growth capital. So for the next 2 to 3 years, the banking sector overall is looking very, very promising. And that's one of the reasons why we are overweight. On the other hand, because it's such a large sector, 35-40% of the index, and it is because of the high ownership by FIIs, there is massive, selling across the board in this particular sector. So, we have to use this as an opportunity rather than say that, banking is experiencing a lot of selling, so let me cut my exposure and then look for some defensive stock, right? We don't want to do that because, we are very much numbers driven. We are very much valuations driven. And our decision making is largely based on valuations. And today is perhaps the best time to be overweight banking. The second area is again consumer discretionary. Now, another sector which is facing headwinds because of raw material cost increases, whether it is metals or plastics or whatever it may be. There is a fair bit of inflation there, and manufacturers are unable to push for further price increases. Further, a lot of the demand in India in the consumer discretionary segment over the last 2 or 3 years has been from the rural economy. And as we know that rural economy hasn't really done well in the last 1 or 2 years. That was primarily because of the wages going down post COVID. There's been a lot of return of migrant workers, and all of them sitting without jobs. So the demand from that side has been very, very low. But come to think of it, there is on the rural side, given the hike in MSPs and given the supply side inflation and all of that, the entire food chain, is experiencing fair bit of inflation, and this is good for farm households, where their earnings go up. In fact, after a decline of almost 4% last year in terms of farm income, in FY23, according to some estimates, farm income is expected to go up by 19%, which is, a phenomenal kind of number in terms of the income generation. And guess where they're going to spend the money? They're going to spend on two-wheelers. They're going to spend on cars. They're going to spend on white goods. They're going to spend on all of these areas, which they have not spent in the last 2 years. So that's the reason why we believe that this sector, again, is looking pretty exciting. Similarly, even in terms of non-farm wages, there is likelihood of a good increase, and hence overall rural economy should do extremely well. And that's the reason why we have positioned ourselves very well, knowing that some of the numbers over the next 1 quarter or 2 quarters may not be that promising, but this gives us an opportunity to buy some of those stocks in this particular pocket, at lower P multiples, right? And finally, the third area is manufacturing, and I've been a big I have a very positive view on manufacturing, primarily because of the growth drivers inbuilt, whether it is Atmanirbhar Bharat or, the PLI schemes. There is a lot of emphasis in terms of domestic domestic production, manufacturing, and creation of jobs, etc., so on and so forth. The infrastructure activity is also moving up. So there is a lot of tailwind in this particular segment. The government is helping industry to kind of set up capacity, global scale capacity through the PLI schemes, and that's going to augur very, very well. If one were to look at, I was looking at certain interesting statistics in terms of India's share in terms of US exports, right? It has actually gone up from 1.8 to almost 2.2. So that's a very substantial number, to look at. When you see that, although in terms of percentage, the size may not be big, but certainly, you're seeing a very good move in terms of India's exports. That is the US imports from India. The percentage has actually gone up. Now, in contrast, post the trade war, which began sometime in 2018-19, in terms of US imports, China's share has gone down from 21.6 to 18.4. So what does this say? It effectively says that US and most of the other parts of the world are actually de-risking. So there's going to be a massive push in this direction. It'll be gradual, like I said, but there's going to be a lot of push towards in this direction to move away from China. It's going to take maybe 8 or 10 years to completely do that. I mean, of course, you can't move completely out of China because China still controls 70% of the supply chain and all of that. So, but then, it's a good beginning, and the next 3 or 4 years, you'll see a massive traction in that direction. So, that's what makes me quite positive in terms of manufacturing sector as a theme. And in addition to that, it's going to be a more broad-based kind of economic growth. Hence, real estate, infrastructure activities, all that is going to participate. So, net from an India economic growth perspective, I think we're going to see excellent growth prospects, and that's why our position in terms of the portfolios is largely governed by that, and not governed by these events like the war in Russia and all of that, which may create a temporary phase of underperformance for us, but we are okay with that because we realize that once we come out of this, and growth will dominate as a theme, and hence a lot of these companies will essentially do very well. So we are taking the opportunity of using this correction as in terms of adding to some of the stocks within the sectors that I mentioned. Thanks everyone. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.